This is the Future of Finance. Hi, everyone. Welcome to the Future of Finance. I'm your host, Georges Dyer, and today we're diving into the world of climate tech venture capital with Temple Fennell, who's the co-founder and managing director of Clean Energy Ventures. Temple shares how he and his team back early-stage companies tackling some of the hardest to decarbonize sectors, from concrete and ammonia to cooling systems and battery recycling, with the bold goal of every company they invest in mitigating 2.5 gigatons of carbon dioxide by 2050. We talk about what makes a great climate tech investment, how Temple balances risk and financial returns with impact, and how they measure emission reduction potential of the companies they invest in. He also shares how investors can better support diversity in innovation and what trends he's watching, gives some advice for students entering the space, and a whole lot more. It's a fascinating conversation about scaling solutions and some sectors that we don't normally talk about, and how investing in these can create a safer climate for everyone. So I hope you enjoy it, and if you haven't already, please follow the show, share it with your networks. And now here's Temple. Hey Temple, how you doing? Welcome to the podcast.
Thank you, George. It's very nice to be here. Thank you.
Yeah, it's great to see you. How's everything going? Are you staying warm? Are you in the Boston area right now, like I am?
Well, I actually just got back from Iceland, where I experienced
Wow,
three of probably the most consecutive beautiful days they say they've had in decades. It was sunny
nice.
and warm and gorgeous.
Oh, that's great. I've never been. I've always wanted to go. The landscape just looks incredible. Um, and you missed, yeah, some pretty terrible weather around here for late May in Boston. It's felt like winter.
Yeah, I know. And nasty wet.
Yeah, yeah, wild. Well, really appreciate you taking the time and welcome back. So just to kick off for our listeners, if you wouldn't mind, give us a little sense of your work, what kind of sparked your interest in clean energy and in venture investing, and how you came to be involved with clean energy ventures.
Yeah, and I'll try to make this relatively quick because it is a bit of a long story because I've been doing this really since 2007. On the venture side, I'm a systems engineer by training. I started a couple of technology businesses in the 90s that were funded by NEA and so the usual suspects of VC guys. It was architect software architecture client server stuff. One was based on a technology that I patented with a few others. And then I started a project finance fintech combination of a fund and a fintech company back in the 2000s, really sort of getting deep into project finance and how do you securitize rights and whatnot and do offtake agreements and tax equity. And then 23 years ago tomorrow, actually, I married into an oil and gas family. And my wife's family is from Arkansas, Louisiana, Texas. And being part of that family and being initially on the family office board and being very involved with my brother-in-law and and others on the investment strategy, we decided, almost 20 years ago to really start looking at investing in clean energy and sustainable and actually in sustainable agriculture. So the companies, oil and gas, a couple of public companies in the oil and gas, family company that was combined with Potlatch to create PotlatchDeltic, which is a timber and lumber company. And then we have some large scale farms, and we took one farm, a 3,500 acre farm, and converted it to all organic and regenerative starting in 2007. And then I actually, as even though when we started off, we were doing very much downstream. We were we helped, we're initial investors in a large wind company called Apex Clean Wind, run by Sandy Reisky. Sandy was actually the CFO of one of my companies that I had founded, and he resigned to be a wind developer in 1999. So I was aware of this and sort of peripherally seeing what was going on in sort of the downstream side. But as an engineer, I really was more and more interested in the upstream, in initially growth and then, clean tech. But it was one of these situations where the more you know, the more you realize you don't know.
Mm.
And we at the time were doing ag tech for our own, converting our own farm. But as I was looking at clean tech, I just like, wow, this is really difficult. And I initially thought we could do ag tech and clean tech, but the more I got into the two sectors, I realized they're not apples and oranges. That seems sort of obvious that they might be, but I say that they're more like apples and Formula One tires. They're like completely different sectors, completely different stakeholders,
Hmm.
completely different relationships. And so I really ended up choosing one over the other, which was clean tech. And then about that time, sort of after the financial crisis, I started looking at the companies and who was financing the companies that were in our portfolio, and realized they were really mostly from most of the new capital was from a handful of families. And those families were like the Walton family and Jeremy Grantham and Prelude and Capricorn, and these families formed what many may be familiar with, which is the CREO Syndicate, which stands for Clean Renewable Environment Opportunities. And this was really kind of 2010, 2012. And at the time, we were really the only real source of significant capital. And we came together because we realized, wow, this is really hard. We all have individual expertise. We should be sharing deal flow. We should be sharing our knowledge of these sectors. And that syndicate has now grown. Where I was in Iceland was actually the European gathering of the CREO members.
Very nice.
And they're also not just families now, there's some large pensions and endowments as well. Um, but it's now about 230 families, I think, 250 maybe.
Wow.
It's more than $1 trillion in private wealth. We're typically investing 10 to $15 billion a year in the energy, food, water, oceans, natural capital sectors. And many of and also standing up a number of funds, including Clean Energy Ventures, back in 2017, and being sort of the largest investors. Were primarily families from CREO.
Mm.
Uh, and so part of, realizing that I really was getting really not knowledgeable enough or deep enough, and our family didn't have a big enough team to really go early stage, I actually decided that I wanted to go back to school. So I applied to be a fellow at MIT in the Sloan School around 2012, 13, came up to Cambridge, and I was part of this syndicate, and I was looking at sort of what was required to really go up into to the early stage and even the growth stage, because quite frankly, I think to be a growth stage investor in clean energy and clean energy technologies, any kind of climate tech, you have to have a very strong perspective and certainly very strong access to early stage technologies to be able to invest in growth stage, because these growth stage companies can be made obsolete very quickly, with technologies that are being brought into the market.
Mm.
So when I was up here, I kept hearing about this other syndicate called the Clean Energy Venture Group, which was even formed even earlier than when we started investing in 2007. Clean Energy Venture Group was founded by my partners, Dan Goldman and Dave Miller, as well as people like Jamie Rosenfeld and Ralph Earl and others, Jeff Weiss. And it was really a syndicate of people that I was, that I had a lot of sort of affiliate affection for, which were the entrepreneurs and engineers, operators like myself that had built and scaled businesses. And it was a combination of, scrappy folks like myself that had started these companies from napkins, and also a number of seasoned executives from GE and from Siemens and from companies like JetBlue.
Mm.
Um, and they were all coming together and basically pooling capital together and helping build these companies starting in 2005.
Hmm.
And so I was really kind of between two syndicates. One was this set of families that were joining CREO that had a very strong intent to put capital into these sectors, but didn't necessarily have the technical expertise or the operating expertise in clean energy to really invest and scale these businesses. But they had a significant amount of capital. And then there was the Clean Energy Venture Group that were, engineers, operators from the industry and entrepreneurs that had a lot of technical depth and operating experience, but didn't necessarily have a deep pockets, or as deep a pockets as was necessary to build and scale these businesses.
Hmm.
So it was a sort of a natural marriage between the two, and so I really kind of played sort of the intermediary between the companies. I was still very much involved with the family and in the investment committee,
Hmm.
um, and then ultimately realized, if we if we're going to make a choice, if we're going to build this fund, that I need to really make a choice. And so we ended up 2016, 17, launched a $50 million fund.
Mhm.
And ultimately, and I was going to be an LP in that, not necessarily going to be the GP. And then ultimately, I became clear it was important for a third GP, particularly somebody from the family office, to represent the family offices.
Mm.
And we came to do a first close in 2017. We ended up having $70 million in commitments, and one of the LPs asked us if we could increase it to 100. And so we ended up shutting down, really raising money for about a year while I sort of tied up the strings for my other obligations so I could be a full-time GP for
Mhm.
the fund. When we opened it back up, we ended up blowing through 100 million. Then we stopped taking capital at 110. And there was at that point too, there were a number of strategics that wanted to come in as well, including Tennessee Valley Authority, PTT, the Thai National Oil and Gas Company, Mitsubishi Securities out of Japan, other families in Europe. And so that was the launch of Clean Energy Ventures. And I think somebody at Cambridge told us it was the first early stage clean tech fund that had been launched in 10 years.
Oh wow.
Uh, so,
So yeah,
and
so
believe 110 is considered a lot of money back then, even though it seems tiny now.
yeah, things are changing fast. But so Clean Energy Ventures is a venture capital fund. Clean Energy Venture Group is still going, is that right? As sort of a syndicate?
Yeah, it is, and we're very much symbiotically, hip to hip as
Mhm.
we're in the sector. We're sourcing deals together, diligencing deals. Many of the CEVG members are actually they're limited partners in the fund. They're venture partners for the fund
Mhm.
um, that get carried, and so very much sort of tied together. But yeah, it's
Got it.
absolutely that group's about 35 people right now.
Yeah, that's great. And we'll get to some of the examples of some of the investments you all are making. And I did notice, I thought it was cool how you list some of the co-investors right there on the website. And I saw CEVG on several of them. Um, so talk a little bit more. I mean, you kind of talked about the operating expertise and the technical engineering expertise that the team has. And I sort of have a sense that a lot of the partners came from MIT as well. Is that right? Or am I
Yeah,
mistaken?
many have had some sort of academic affiliation
Yeah.
there for sure, and some still teach and whatnot.
Hmm.
We all do a little bit of teaching there.
Yeah, but it seems like there, a lot of you, as you said, are, have a lot of that technical expertise. So you're going and looking at companies, you bring that knowledge, and I assume that helps you really understand what, as you said, are some pretty technical, difficult, challenging companies to understand and
Yeah,
vet. Hmm. Nice. And you talk about the scale being really important. You focus on startups that can mitigate 2.5 gigatons of CO2 by 2050 as sort of a guiding parameter. So talk about why that sort of scale is important, how you all settled on that as kind of a primary driver when you're looking at companies.
yeah, that's a great question, and I think also importantly, how do we measure it? I
Hmm.
think it's really important as well. So my partners and our team members, Dave Miller in particular, he's been part of Frame and Crane and all the different measurements. And we created something called Dave and Chimbor Gupta, who's also on our team, and others, and now Saurabh Kumar, created a model whereby when we're measuring this 2.5 gigatons, and I'll talk to you about why that's important. Um, we created something called the Simple Emission Reduction Calculator, which
Hmm.
is now being used by more than 1,000 companies and funds around the world, and by Greentown Labs and others, where we're essentially looking at a unit of products sold or a unit of service delivered, and say how much carbon if this product or service enters the market, how much carbon or carbon equivalent. So if it was a carbon ton equivalent, so if it's NOx, it gets a multiplier, or methane, it gets a multiplier. How much will it reduce, remove, or replace versus business as usual or whatever status quo technology or service? And once you can sort of figure out that, and it's can be challenging, but you then but once you kind of figure out that unit carbon reduction, then you essentially simply plug it into the pro forma, the market adoption, the market scale. And the reason it's 2.5 gigatons, this is over 30 years. It's cumulative over 30 years. And the reason that we're doing that is we want to see really, does this company have a potential to scale globally? Or is it, and can it be is a large enough market that its market share can be sizable enough to be able to have that sort of impact? And the reason that we do that is, I as an LP before we started the fund, I was constantly arguing with my GPs about their methodology, their impact methodology
Hmm.
for the numbers that they were reporting in the report. Um, and they were often, loose correlations at best. Um, and so what I would often want them to do is in their pitch decks, they would talk about how they're going to be reducing X or improving something by Y percentage. And I say, guys, so if you do believe you can do that, I'd like you to build that in as an investment criteria with this methodology we've both signed off on. And if you change your methodology, you have to alert us as LPs and let us know that. I don't like to have to unpack your methodology every time I get an impact report.
Hmm.
And so what that does, it creates not a correlation between the impact and the financial returns. There's actual causality. So the more our companies scale, and presumably if it's got good gross margins, the more return it's going to be generating for the fund and therefore the LPs. And it's also going to be causing greater and greater impact, cumulative impact. So we
Hmm.
really want to have a very strong causality between impact and financial returns when it scales.
Yeah, that's great. How did you mention you kind of threw in there the frame and crane tools that are developed, or at least in part by the Prime Coalition, and we've had some other guests on the podcast talking about those. Does your tool kind of align with those methodologies? And how,
It
yeah.
Yeah, it does. I mean, it does. They're certainly related
Hmm.
in a lot of ways. I mean, we are, they're sort of a more macro, if you will, which I don't mean that in I mean they're tremendous tools, and we've been put a lot of input into those. But this tool is really meant for the entrepreneur and for the people to really assess what they are going to be able to generate, right?
Hmm.
I mean, typically what you're seeing is they're saying, we have a total addressable market or, a SAM, and we're going to take X percentage of that market. Well, okay, that's great. We hope you can, but let's double click on that and really talk about what you're going to be able to scale to do.
Hmm.
And we end up having to not pursue a lot of amazing technologies that we see because they just frankly, in our view, can't get to scale.
Hmm.
Um, Frustrating at times, but because we are early stage clean tech, tough tech investors, there are a lot of opportunities. We're usually doing about 4 to 6 deals a year. We've got a large team of, more than 20 when you even 25, 30 when you start adding in the venture partners.
Hmm.
Uh, Even with that large team, we can really only process about 4 to 6 deals.
Hmm.
We have more deals than we can process right now. So having that sort of narrowing function, that force function for narrowing what we're focusing on
Yep.
is really helpful to keep our team, not being completely overwhelmed.
Right, and focused. Do the entrepreneurs, the companies at those stages, kind of appreciate having that tool? Because I imagine a lot of them are trying to figure out what their impact could be. Or does it
Yeah,
vary?
many do.
Yeah.
Frustrated by us, right?
Right. Another thing to do. Well, that's great. And you kind of mentioned the tide of financial returns, and just wanted to touch on that at least quickly because I think there's a lot of misperceptions still in the space, or maybe kind of hangover from earlier versions of clean tech cycles around the financial performance of some of these strategies. So you talked about how some of these companies can scale, and that leads to stronger financial returns. But just talk a little bit about what you're seeing and how you think about the financial returns in this space, and if those, are you seeing those misperceptions out there still, or is that changing?
Well, so what I'm about to say is going to probably annoy many of my peers and friends. But we've been doing this for so long. I don't know, we've out of just maybe wounds and scars over the last 20 years and just, sort of maybe having more of a conservative skeptical view.
Hmm.
When we're coming in, as I was mentioning before, being engineers and operators, we're essentially company builders, and we're known for that. We're extremely hands-on. When we're coming in, it's typically the seed stage. Usually, we're usually almost always the lead or a co-lead at least, and the largest check, or at least as large as the next one. And we're coming in and it takes us, unfortunately, about 3 to 6 months to really dig in. And, the three things that we look at are team, market, and technology. Technology, oddly enough, is sometimes the easiest thing for us to assess, but understanding how is this team going to be able to go from 2 to 3 people coming out of the lab with a product that's ready to be commercialized. So we come in at that pre-commercialization stage where there is the value proposition, the techno-economic analysis shows that this company can, in fact, be competitive with, whatever is happening, whatever they're trying to replace, remove, or substitute, or reduce in the market. And can it scale and compete? And a lot of these companies, will ultimately need to compete in commodity markets, whether it's sustainable aviation fuel, hydrogen, you name it. And so that takes a good bit of analysis to do around markets and then anticipating markets. We try not to necessarily invest in companies where markets don't exist and, wishing and hoping that a market will show up.
Hmm.
And then, when you're looking at teams, they're moving from those 3 people to 15 people, and that's a very different type of organization and requires a very different type of leadership and leadership skills. And
Hmm.
then and at that point, in that sort of second phase, at the end of the second phase, which is usually Series A for us, is they need to show that they've got a demonstrable customer demand and they've de-risked the technology. And there's still maybe some engineering challenges that are required to get to the competitive TEA, the techno-economic analysis, but they're typically generating revenue at that point, and we've got significant investments from the corporate strategics. About 70 to 80% of our companies have one or more strategics on the cap table. In fact, strategics are a great source of deal flow for us. They bring us deals saying, we love this team. It's an amazing technology. We know exactly where it's going to fit into our business unit. But we as corporate CVCs, we're not the greatest helping these companies cross this chasm from pre-commercialization through early commercialization to a proven commercialization point. And you guys, that's what you guys are purpose-built to do. I mean, you guys are fundamentally customer or company builders. And we
Hmm.
want them to make that crossing, these companies to make that crossing to the proven commercialization with no more than requiring more than about 30 to $50 million.
Hmm.
And so that also forces constraints onto what we're able to approve. And people say, why 30 to $50 million, Temple and Dan and Dave? And we say, well, because the reality is most of unless you're SPACing or de-SPACing or IPOs, most of the exits are really to corporates still. 95% of the exits are still to corporates, and corporates, particularly now in the US, less more aggressive or more willing to take more long-term perspectives in Europe. But in the short term, getting a product in the market that that has longer than a 3-year payback, forget about it. Really, that's not going to work. And they're ultimately, when you're looking at the exit value of these companies based on their revenue, based on EBITDA, those exit values are pretty well tightly bounded within the CVC acquisition M&A world, around 300 to 500 million. So you really can't afford, you're not going to generate decent returns for the companies if you're coming in at the pre-seed or the seed at $30 million pre, and you need to basically spend 100, $200 million to build a pilot plant that's going to show that it's competitive on a price basis and performance basis in the market. Hard to get a really, a 10x return for the LPs if you're spending, 2 to 300 million dollars and exiting for 3 to 500 million dollars.
Hmm.
So we're still very conservative with that sort of model.
Hmm.
Now, we certainly hope the power curve is going to kick in. And you're going to see corporate America buying these technologies, but they're not really doing it now. There's really if you're a corporate CEO, once you've signed, that whatever you sign, let's say it's the SBTI net zero commitments. Reality is there's no penalty for you not decarbonizing.
Hmm.
What's interesting though is there are so most corporations in sectors are not decarbonizing. What's interesting though is the ones that are decarbonizing are some of the hardest to abate sectors like mining, concrete, steel, or
Hmm.
cement. To be more specific, steel shipping. But for the most part, most are not. So until that actually changes, which is going to be hard to change in the US, it's trying to change in Europe.
Hmm.
Um, you got to basically go into the sweet spot of, you have to prepare these companies to be bought in the sweet spot of these corporates.
Yeah,
Um,
interesting. And I just to define a couple things and make sure I understand them correctly. When you say strategics, those are typically corporate venture capital funds that will invest, but also they're strategic because they will help with that exit or just understand the market that the
yeah,
company's in.
exactly. And sometimes it's a CVC, sometimes it's the parent company, you know. I mean, the parent company set up the CVC to be able to find technologies that fit into their value proposition, their business units.
Hmm. Got it. Got it. Well, let's talk about some of those specific examples because I think that's where a lot of this gets tangible and it's really exciting to see what you all are working with in terms of companies. And, you kind of just mentioned some of them, but you've got your portfolio companies right there on the website and scrolling through. It's um, concrete or cement, hydrogen, ammonia, materials, water, cooling systems, battery recycling, like some of these things that, the average person might not think of as climate solutions necessarily. But we can run through them, but if you have a couple that you maybe want to just talk through that are particularly exciting that people might not be familiar with and why they're important in terms of hitting those kind of 2.5 gigaton reduction targets.
Yeah, no, happy to. So when we're looking at these technologies, we try to make a distinction between a nice to have and a must have.
Hmm.
And for the must-haves, in our view, again, it goes back to the economics. So we're focusing on companies that we feel can offer the company a payback within sort of 3 years. 5 years is okay as well for some. Once you start looking at 7 to 10 year paybacks, those get quite difficult to actually sell. If you've got under 3 year and you're looking at significant improvement in performance and a significantly lower cost, they move from a nice to have to a must have. If you got sort of a 5 to 10% possible improvement, you're not. It's hard to get corporates to step up. It's hard to get the procurement people to take that switching cost risk. It's hard to get the operational folks to do it. It's hard to get the CEO. I mean, the reality is, we call this the paradox of the 12, in that most CEOs and CFOs in corporate America are measured every 12 weeks, which is a quarter. They are compensated in bonus on what they've done the previous 12 years. Average tenure, is sort of at a range of 4 to 7 years. So trying to convince them to take something that is not going to have a payback during the tenure is quite challenging.
Hmm.
Now, this is why the margin, of really a 40% lower cost leads to a much shorter payback period. So we really, that's a big part of our pre-investment diligence. Now, there are other companies that are existential, and I'll talk about some of those. So if you look at InCycle, right, the Trump administration and, every place around the world, we're trying to onshore these manufacturings, right? The problem is, of course, is critical minerals are, as we know, are that China has a stranglehold on those. And what InCycle is able to do is take that nasty black mass that comes out of a redwood battery recycling facility or life cycle. And it's highly modular. You can actually build it next to the redwood plant, and it's an electrochemical process that effectively takes out the cobalt, the nickel, manganese out of the black mass. So it's all about sort of recycling these critical minerals, and it can be any kind of e-waste. It can actually be tailing ponds, which often are loaded with all sorts of critical minerals.
Hmm.
Um, Very low ppms, it can extract those out of the tailing pond. So that's
Wow.
actually an existential, it's a must-have, but it's also existential for these businesses
Hmm.
to actually operate.
And that one is nth cycle is like the letter N, nth
Yes.
cycle. Yeah. And so yeah, I'm curious about that because, we hear a lot about, the need to recycle and just the demand that's going to be coming for those materials in batteries. And how are they scaling? Is that like, are there other companies like that? Is that going to be pretty solvable in the near future or? How's it looking?
We don't see, again, I mean, I certainly have my bias. We don't see any other extraction technologies that can do what InCycle does at the low cost that InCycle is able to do it at. But also, it needs to be highly modular. So now, when you're extracting these critical minerals, and it can even be sort of copper extraction out of heaps, you're using either a pyrometallurgical process or a hydrometallurgical. So either using a lot of heat or you're using a lot of solvents, both of which can require a significant amount of energy. So you're often having to ship it to places like Quebec, where there's very, very low energy,
Mm.
versus being able to build and install an in-cycle facility right at the point of collection or right at the mine, even. So yeah, so we feel like that's going to be essential.
Yeah, very cool. What else? What are some of the other kind of, again, like maybe not immediately thought of? I saw you've got one company that focuses on ammonia.
Yeah. Well, yeah, there, and again, this is where we get pretty conservative about certain things. So I'll talk about hydrogen generally and broadly.
Hmm.
But I have to say we're somewhat skeptical about the time frame it's going to take to actually build a full hydrogen economy.
Hmm.
And we're somewhat reticent to make single hydrogen bets, even as sort of amazing as white hydrogen or natural hydrogen is. And so when you're talking about ammonia, the green ammonia, the key is getting the green hydrogen. And so we're not sure where the source is, but we have a company called Ayrton that actually is able to, on site, be able to create a very stable ammonia. It's almost like a gel that they're able to just to transport without with the volatility and combustibility of typical hydrogen or the leaks. And so, we try to solve sort of the fundamental, the first science problems of some of these scales.
Hmm.
And so we could apply that to the green ammonia space. We have one investment in Tel Aviv called Nitrofix that we're working on that, but it's still very, very early.
Hmm.
Um,
And tell us, like, why, tell people why that's important. What is ammonia used for, and what are the impacts
oh,
otherwise?
yeah, I mean, nitrogen, synthetic fertilizers, 80% of all ammonia is used for fertilizers, right? Synthetic nitrogen. I mean, we wouldn't have 9 billion people on this planet if it weren't for Haber-Bosch inventing that. But also, I mean, it could be used for transportation if it's low enough cost, and safe enough at some point. So yeah, it could be, people say that it could significantly replace a lot of diesel and Jet A and things like that. We're not entirely convinced of that yet, but
Hmm. Gotcha. And I see you've got another one focused on sustainable aviation fuel. How does that work? And I guess how big a piece of the global emissions puzzle is the aviation fuel?
yeah, good question. I'm not going to be able to give you a sort of a clear answer. Well, I could tell you where it is right now. I'm sort of the Jet A, but yeah, we feel like this particular company out of Oxford University, they, it is all sort of it's dependent on the price of hydrogen, which a lot of these companies are, whether it's SAF or most sort of chemicals and chemical fuels.
Hmm.
Um, but yeah, I mean, what we were looking at is depending on the price of hydrogen, they can get pretty close to Jet A. Now, you know, company it does, again, me maybe disclose, be overly skeptical, but it is dependent on the regulation of the world economy wanting to decarbonize aviation,
Hmm.
enforcing decarbonization. But right now, the green SAF is, green aviation fuel is selling usually somewhere or it's minimum of 3x the price of Jet A, and even sometimes 6 to 8 times. But that's not sustainable, right? I mean, not for a very large percentage of the fuel required for aviation.
Hmm.
So these guys are able to get very, very close to Jet A, and when we look at their cost curve. And so it took us quite a while to be able to find them. And the other thing that it's also somewhat similar to most of our companies, pretty much all of our companies, is it's highly modular. It doesn't need to have a massive, massive build to prove out the techno-economics. It can be proven at a relatively small investment
Hmm.
to show that it's competitive.
Got it. Got it. And then what about maybe just one more, the aqua membranes, which is reverse osmosis water filtration? What's that application and how does that fit in?
Yeah, I mean, that one is absolutely global. So, if you look at the water space, some scary statistics, if 40% of the world's population is water stressed. If we decided we were going to desalinate it with all of the with the current existing technologies, that would emit more emissions, given that most of that energy would be coming from something that's fossil fuel based. It would cause more emissions than the entire U.S. economy.
Hmm.
It's like 6 or 7 gigs a year of emissions, and it's just completely unsustainable. It's also, the world is waking up to the fact that you can't essentially rent water off the municipal systems and then dump it back. Companies need to own their water, not people necessarily, but I mean, so Micron is a big investor in the company because they use what's called ultra pure water. They need to clean that water up and reuse it. And it really, eventually it doesn't really matter what industry you're in that requires significant water. You're not going to be able to dump it, take it off the municipal water system or out of the aquifers and be able to dump it back. So what, but technical innovation in water is extremely difficult. And there has been very, very little, even over the last 20 or 30 years. One of the big problems with reverse osmosis, which is the main way of cleaning up water, is requires a tremendous amount of pressure to push water through that membrane.
Hmm.
And one of the main reasons is you have to separate the membranes by a piece of mesh. It's like a lacrosse stick mesh, if everyone knows what that is. And that creates a tortuous path for the water to push over, so a lot of pressure. It also clogs up the filters, and that degrades the membranes. What these guys have figured out how to do, and the only ones in the world that are doing it, is the print the spacer actually on the membrane. So it's much less of a tortuous path, much lower energy, much less degradation of the actual membranes, much more membranes you can many more square feet of membranes you can actually put into the membrane. So it really truly is a better, faster, cheaper way of cleaning up water. And that includes desalinization, that includes ultra pure water. And they have deals with everybody from Micron to, working with beverage companies, dairies, you name it, everybody that needs water.
Hmm. That's awesome. I mean, it's so
And
cool
it's a
just
significantly lower cost.
yeah, nice. I mean, it's so cool to hear all this because we talk a lot about how sustainability can be such a driver of innovation and just opportunity and growth in the sense of growing solutions. And yeah, it's just cool to see these companies that you're working with that are doing it. I'm just curious too, as we're kind of thinking about these big sectors that contribute to overall global emissions from materials to water and the like. Obviously, everyone's thinking and talking a lot about AI and the energy demands there, and also maybe the potential to help drive solutions. Does that enter into your work much at all?
Oh yeah, absolutely. Yes, for sure. In fact, we have a super composite company called Boston Materials. It's a heat exchanger that's being put into computers. It's significantly lowering the heat
Mm,
footprint, within these huge server farms.
yeah,
Another one is, and so that's a must have.
yeah.
So not even necessarily that price sensitive because it's not reducing, removing some other existing technology or product. Another one, and this is kind of goes back to what we talked about a little bit, is what are some of the most overlooked sectors right now?
Hmm.
And one area that doesn't get nearly enough attention is cooling.
Yeah.
Generally, keeping people cool, keeping data cool now, food, medicine. And the reality is, 20% of all electricity globally is used to keep is for cooling.
Hmm.
And people have not really invested in that. I mean, when we're trying to keep data cool or people cool, we're typically running compressors 24/7. You can't just decide to turn it off because there's no electricity on the grid.
Hmm.
Uh, Whether it's battery manufacturing or, commercial HVAC or data centers. And so we have a company called Rebound that is actually it's really amazing technology for making ice and deploying that on an as needed basis. And they store it effectively as a thermal battery. They
Oh
make it
wow.
at night or curtails. And then they can they can deploy it on, when whatever application is needed, and it can drop down to as low as minus 40 degrees C. So
Hmm.
they've got a big deal with Lineage Logistics, which is the largest cold storage company in the world.
Hmm.
And Lineage, is we're in pilots, right? We've actually two successful pilots. We're executing on POs for Lineage,
Hmm.
and the idea is rolling this out globally here in the next few years. And data centers are all over this at the moment
Yeah.
because 40% of the cost can actually, or the pull can actually be from just keeping cool.
Yeah, that is so great to hear. As top of mind, I was just reading an article this morning, actually from the MIT Business Review, about this topic and how right now I think it said data centers account for something like 4% of global emissions, and over the next 5 years, it could go up to 12%. And when you think of different pieces of the puzzle, it's like that's just huge. So, I mean,
When you
how do you?
think about,
Yeah, go ahead.
I'm sorry, I didn't mean to interrupt you.
No, I was just going to say, see if you had a thought on because of these new solutions and technologies coming in, do you feel like there's good opportunity to bend that curve and have, those that energy demand not be as dramatically high,
Well, for AI, no,
just
right?
because there's going to be so much more of it, and
Yes,
yeah.
they're going to continue to build out to the limit. The but yeah, I mean, so when you're thinking about cooling, right? I mean, it's a horrible negative. It's a feedback loop, right? But it's a positive feedback loop with terrible negative consequences
Right.
because the more emissions we release, the warmer it gets, which means we have to run more compressors and
Hmm.
bring more compressors online. It's a disastrous cycle.
Hmm.
And Rebound really is from what we can tell, is the only company that has a solution to break that cycle.
Yeah, that's very cool. It's called Rebound is the name of the company.
Rebound Technologies, yeah.
Rebound
So
Technologies.
they're in the process now of scaling.
Yeah. Nice. Very cool. And I guess just one other question, like kind of coming back or away from the examples. When you think about risk, obviously you're working with startups, and I'm sure that's a big part of it. How much is the policy aspects of all of this, you know, central to your thinking? You sort of mentioned the differences between the U.S. and Europe right now. Does that guide a lot of your decision making, or is a lot of this policy agnostic?
No, well, the companies are policy agnostic. We
Hmm.
try for them to be. It definitely drives a decision because we're not taking on companies that require policy incentives, subsidy, regulation. Now, it's of course impossible to get completely away from it because they rely on regulated infrastructure like the grid, for instance. But yeah, we are not investing in companies waiting for not even waiting for CBAM and all the regulations happening in Europe. These companies, they have to be better, cheaper, and ultimately, in our view, we'd like them to be cleaner, but they primarily need to be better, faster to deploy and cheaper.
Hmm.
And that actually falls, directly into the sweet spot of Secretary of Energy in the Trump administration. I mean, if you look at what they're investing in, I mean, they're investing in grid resilience and grid security and, critical minerals and supply chains, advanced manufacturing, AI. 90% of our portfolio, 80, 90% of our portfolio fall directly in the bullseye of the current administration's needs because it's really about, we may say it's better, faster, cleaner, but what they're looking at is more resilient, cheaper, and faster to deploy.
Hmm. Yeah, that's great. And talk a little bit about, you're talking about all the climate impacts, and I know you all have been really thoughtful about diversity in all of this and in the climate innovation space, and maybe just talk a little bit about how you think about that and how that shows up in your work and the investment process.
Yeah, that's interesting. I mean, so gosh, I think we have two or three companies in the deal flow right now that have diverse founders. And, quite frankly, whether we're hiring people or basically helping our portfolios hire,
Hmm.
or even looking at deals, for us, particularly when we're hiring, it's really not about who you're choosing. It's about where you're sourcing, right? I mean, if you look at our portfolio, a very small portion or relatively small portion of our portfolio comes from the centers of, the Boston area. There are a number of companies here, but we have companies out of Albuquerque, New Mexico, and, Commerce City, Denver and Milwaukee and all over the place, the mid-Atlantic area.
Hmm.
And for us, it's a pure meritocracy about sourcing, and that's true for the people as well. When we were building our team, we were looking even for CEOs or companies, we were being really frustrated that most all of the recruiters that we were talking to in the US were sending us basically the same list of people that were with very little diversity in those lists.
Hmm.
The way that we actually, even internally try to insulate ourselves from having any bias is all of the initial recruiting and initial vetting actually edits and redacts from all of the resumes and bias. Now, there's a certain point when you're actually meeting people, and then and we also redact schools as well
Hmm.
because school can create bias.
Yeah.
Um, but once you've sort of made it to this first couple of filters, then it becomes, it's a pure meritocracy at that point.
Hmm.
That's also true for our companies as well.
Yeah, that's fantastic. And I think it's really interesting, to hear about the geographic diversity too, because I think that's critical for, you know, all of this development and just in some of the political dynamics too, for people to see that these drivers, these opportunities are happening all over the country.
And I
Um,
think 30 to 40% of our portfolio have founders and or CEOs that or at least the C-suite have people from diverse backgrounds,
mhm. Nice.
at least underrepresented.
Yeah, excellent. Very cool. Well, Temple, we're coming to the end of our time, and I want to just wrap up with a quick series of rapid fire questions for just quick responses.
Okay.
So let's dive in with one climate trend that you think is overhyped.
Oh, yeah. You and I talked a little bit about that. It's hard given that our model is really about sort of fast deployment and getting these companies in the market in 3 to 5 years. I do worry that the amount of capital that's flowing into a number of big sectors like direct air capture, for instance, um, the payback period is for us is just not really appropriate for the VC model.
Hmm.
Uh, so we've avoided that. EV charging has been quite challenging for us as well. I don't know if it's overhyped or not now. I think it was for a little while,
Hmm.
mostly because of, if we feel like it really needs to be built out primarily by non-venture money.
Hmm.
Um, I mentioned earlier that we're still kind of waiting to see how the hydrogen market is going to form, and you see a lot of the money that's been spent around high. And when I think about hydrogen, I think also sort of around even green steel and things like that. We have a really great green steel company called Hertha Metals
Hmm.
that is basically able to produce at a volume and at a cost um, that is really is going to be able to get in the is going to be in the market very soon. So when I think about what's overhyped, there are some venture investing going into companies that are going to take much longer and require much more capital than I think the funders are actually anticipating. I mean,
Yeah.
we're a 10-year fund now. So how are you going to get into these early stage and get to an exit within 10 years is really quite challenging.
Yeah. So it's more about having the appropriate types of capital focused on different sectors or solutions.
Yes, exactly. Thank
Yeah.
you.
Hmm.
Well said.
Yeah. Cool. All right. And what about underappreciated? Again, are there just sort of areas? I think, maybe this is too basic, but I just feel like a lot of people think, oh, renewable energy, EV charging stuff that they sort of see as direct solutions to emissions that they see. And that there are some that are just less obvious, whether it's steel or cement or ammonia. Do you feel like those are generally underappreciated, or do you think the investment community has a good sense of where the emissions are coming from and where the opportunities to reduce them are?
I think well, ammonia maybe not, but for the others, for steel, cement, certainly,
Hmm.
mining, certainly. I mean, and mostly it's driven by the corporate VCs. I mean, they're very active in investing in these companies and driving technologies. I do think, things like, the other sort of hard to debate. I mean, to mitigate sectors like long haul trucking. Again, I keep sort of hammering on cold chain, but even something like transport refrigeration units, right? I
Yeah.
mean, huge issues in cities. And so I just think really, I mean, I'd love to see many more if VC funds really put their brain about how do we create a much lower emission cooling system, cold chain system. Or when I say system, like global system,
Yeah.
but it's not a lot is being focused on that.
Yeah. That's a great point. All right, what about the most surprising thing that you've learned over this journey getting into clean energy space?
Oh, I I would well over the 20 years, how long it takes to actually get these technologies adopted. It's
Hmm.
not these are not SaaS models. They're not, enterprise software models. It's basically, I mean, and there are natural limits to how quickly you can actually drive innovation, and actually, get these companies de-risked and deployed. And I think a lot of this frustration that some of the, maybe the large pensions endowments are experiencing is the fact that it does take longer. It's not Uber. It's not,
Hmm.
Airbnb. And so many of them stay out of it. But, as others have said, we software didn't get us into this problem, and it's not going to get us out. Now, software may cause the problem to be even worse than it is right now.
Hmm.
We'll have to see.
Yeah.
But
No,
yeah, I mean, patience, and the biggest thing is like spending the right amount of capital in the right technology and being
hmm
patient to let them develop.
Yeah, it's a great point, and it's really inspiring the work you're doing for that reason because, yeah, it's hard but necessary for this transition. All right, back to policy. If you could just wave a magic wand and implement one policy around maybe around climate or something else, what would that be?
Oh, well, I mean, of course, price on carbon,
Yeah.
right? I mean, that's the obvious one.
Hmm.
And so we're not dependent on voluntary markets, a global carbon tax, but that's a pretty far out dream. I would like, and again, you have to separate Europe and US and in Asia and other parts of the world. But in the US, it's just if there was just some political will to really force companies to have to decarbonize.
Hmm.
There's no political will on either side of the aisle to actually cause that kind of regulation. You
Yeah.
know, and honestly, my view is, simple things that are incredibly difficult, like dismantling, readdressing Citizen United, dismantling the PAC system by actually having people that are putting money or donations to 501(c)(4)s to actually have to be disclosed. Those things would have radical impacts on regulation, on all sorts of aspects of government, much less the elections.
Yeah. Yeah, and yeah, I think including the political will to do those things that are really addressing externalities that government or insurance or taxpayers are going to have to pay for one way or another. So there's a clear rationale to do it, but yeah,
Yeah.
it
But
does.
even something that's just like forcing disclosure of 501(c)(4)s would have a radical knock-on effect.
Yeah. Hmm. Nice.
Oh,
Okay, how about a resource? Could be a book, podcast, article, person that you think people should check out.
well, I don't want to mimic Bill Gates too much, but Vaclav Smil is just, I mean, he just kind of blows your mind, even though I may not agree with everything he's writing, the depth of their thinking and what they're doing. I'm quite inspired by, like, even funds and that, what Lucas Walton is doing, particularly in terms of a person and
Hmm.
what he has done and he is doing with S2G. I mean, it's just phenomenal. And how he basically built the ocean industry and trying to address, ocean health. I mean, just really a phenomenally inspiring person.
Yeah, very cool. All right, and what speaking of inspiring, what's giving you the most hope right now that we're going to be able to address these climate challenges?
Oh, a hope or a wish. Kind of one and the same. I mean,
Yeah.
honestly, I think it's going to be Europe. I mean, we're just waiting to see if these regulations will have the teeth necessary. I mean, it's already feeling like it's a little bit it's weakening. But yeah, I mean, I do have great hope. In fact, in the case of InCycle, we did build the initial pilot plant in Ohio. We're now building the next big plant in the Netherlands. I mean, there's so much support over there that you
Hmm.
just don't hear. I just this idea of bringing manufacturing back to the US is going to be quite challenging considering the labor base and the lack of education. And I'm hoping that Europe is going to be able to, at least provide markets for these technologies that the US can't.
Hmm. Yeah, got it. And then how about personally, when you're not working on all these issues, what might we find you doing?
Well, usually it depends what season it is, but cooking breakfast sandwiches and burgers at my kids' regattas. We have two regattas this weekend. They go to the public school here in Cambridge, and we my one I have three daughters, and one's a Cox. The
Uh-huh.
other's in the someone I believe they're second in the state right now, which is really
Wow.
exciting. So, um,
Nice.
do a lot of that, but I do a lot, very much in the family office world, training, particularly next gens. Like,
Yep.
how do you bring these types of investments that are long term, that have significant social impact into your family? You're a multi-billion dollar, multi-generational family. How do you get the family sort of activated?
Hmm.
Get- They will all have the intent to do it, but actually activating that intent into actual real commitments is difficult. So I do a fair amount of teaching around that.
Yeah, that's right. I forgot that. I mean, you've been doing that for a long time now, right? Now that whole program at it's affiliated
Yeah,
with Harvard. Yep.
yeah, the Impact Investing for the Next Generation program, that's
Hmm.
now at MIT and University of Zurich. We
Okay.
have 250 graduates, and we've been doing it for 10 years.
Yeah, that's awesome. Nice. Well, Temple, a couple final questions we ask all our guests. Just given your perspective on these markets and what you're doing and the role of capital and finance, what do you think the future of finance needs to look like if we're going to create a sustainable society here?
Yeah, a lot more innovation, a lot more types of finance, and we're working on that. We're working at the Creo families. We're working on it, with internally, but certainly first of a kind and next of a kind type of plants to get plant builds. But there's some major gaps. So, a good example are both rebound and aquamembrane. So people talk a lot about the missing middle, and there's two types. One is the plant type of missing middle to build these first of a kind and next of a kind plants.
Hmm.
And those plants are typically producing a volume of gas, liquid, mineral, something, material of some sort. But it's also manufacturing. This is a problem, that I touched on earlier. But if you are some of these companies are able to produce maybe 10 or 100 units a month, and they have demand for 10,000, there's virtually no financing available to scale them to that next level.
Hmm.
Uh, and even something as underwriting take or pay agreement. So if a big company like Micron said that, hey, we want to buy $30 million, but we're going to write a purchase order until you guys can show us you can produce $30 million. That should be something that would be relatively easy to underwrite.
Fantastic. And then finally, you mentioned your work with the next generation. What kind of advice do you give them, or would you give to other college students that might be listening or young people interested in a career in this space?
Yeah, just don't be worried about going deep, trying to understand really, and there's plenty of data, even using something like Perplexity to ask simple questions about sort of how are these things financed? What are the big gaps? You know, there's a lot that you can learn, and we're all on a learning curve here. And just because we've been doing it for 20 years, we're learning more than in every single day. So just jump in. And I just, you know, if you can learn more about project finance on your own and have that was your entry point, which was my entry point,
Hmm.
um, just roll up your sleeves and dive in
Awesome. I love it.
and go to school, man. Just get, if you have a disposition for a technical degree in science or engineering, please follow that passion.
Yeah, yeah, we definitely need more of that. Well, Temple, thank you again for the time and again for all the great work you guys are doing at Clean Energy Ventures and with all of your other affiliations. We really appreciate it. It's always great to catch up, and I hope we get
Yes.
to talk again
Yes.
soon.
All right. Terrific. Take care.
Take care. Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.